Hi, I'm Pattu from FreeFinCal. I have talked about portfolio rebalancing several times in my articles and videos. Let's talk about it one more time, and this time a case of regret. A reader says that he missed rebalancing his portfolio last year just before the market started falling because he was scared of tax, and he thought that the bull market would continue and he would miss out on gains if he rebalanced in this situation means shifting some amount of equity to fixed income. So now he says that he missed that opportunity and now he's suffering higher losses, and he has learned his lesson. And he says, I'm going to now rebalance like a robot every year. Now this there are many aspects of rebalancing. I've talked about this several times. So the primary ones are that, why are you doing portfolio rebalancing? So first you must have a proper asset allocation target in place. So let's say it is 50% equity and 50% fixed income. Now rebalancing is relevant only when your actual asset allocation is close to this. It is fluctuating about this target asset allocation. Some people have 50% equity as a target, but their actual portfolio only has 10% equity. So for those people, rebalancing is not relevant. They should be focused on increasing equity exposure as much as possible. Of course, this is a very wonderful time to do that. Such people can shift some money from fixed income to equity and increase their equity portfolio. Now the second point is that the primary aspect of rebalancing is that you should look for deviations from your target asset allocation, and you should have the maturity to shift money from a asset class that is performing well to another asset class that is not relatively performing well. So in this case, you have to shift money from equity, which has been doing well, to fixed income. In my situation, last year I rebalanced twice, once in April, once in September 2021. Of course, I can't say that I expected the market to fall and all that. No, it's just sheer luck. But it was obvious to me that my equity asset allocation had increased significantly. Equity weight had increased significantly. It was time to shift some of it to the safety of debt, and that's the only reason I did it. And it's only luck that after I did it, the market fell. There have been several instances in the past where after I rebalance, the market will move further up. That's life. I mean, you don't get it right all the time. It doesn't matter. Future market movements after you do the portfolio rebalancing matters very little. And you must be very clear about why you are doing portfolio rebalancing. Why are you doing it? You want to do it because you want to reduce the fluctuations in the overall return of your portfolio. If you don't rebalance, your portfolio return, that is overall equity portfolio, equity return, overall debt return, and together combined, all those three numbers will fluctuate without any control. Where you are bringing some measure of control by rebalancing, you are reducing the fluctuations. I have talked about this in previous videos several times. And because your aim is to reduce overall portfolio return volatility, exit load doesn't matter, tax doesn't matter. In fact, I will give you an example of why it doesn't matter. So you should do it nevertheless. Of course, you don't need to rebalance every year like this person has mentioned in his email to me. You don't need to rebalance every year. You can do it with a 5% threshold rebalancing. For example, if you have 50% equity and 50% fixed income as a target, you don't need to rebalance as long as your equity asset allocation is within 5% of 50%. That is, as long as it is less than 55% and more than 45%, you don't need to rebalance. If it goes beyond those limits, if the equity weight becomes higher than 55% or lesser than 45%, then you can do a rebalance. This will automatically save you some tax, because that's not going to happen every year in your investing journey. So that much is enough. Now let me give you some numbers from my rebalancing. So I have done it twice and I paid tax, I've just filed my ITR, so I know these numbers. For combining both rebalancing events, the total amount of tax I paid is only 1.6% of my annual investment for the goal, for my goals. It's just 1.6% of the total amount I invest for both my goals, or it is only 19% of my monthly investment. The tax paid is only 0.14% of my current combined corpus, retirement plus child's future, as of October 2021. That is at that time when I rebalanced in September. So as of October 2021, 1st October or something like that, at that time the tax paid is only 0.14%. Today the portfolio has gone down a little bit, but that doesn't matter. It only matters when I did the rebalance, and it is only 0.17% of its value today. 0.14% October 2021, 0.17% of its value today. So it's really nothing. I mean, I have safeguarded about 5 to 7%, maybe even more, of my equity investment at that time. I have safely pushed it into PPF. Like I said, I maximized my PPF accounts only via like this in the past, and safeguarding 5 to 7% of equity investment, I can happily lose 0.2%. It's no problem. It's not a big deal. I will pay this price every time. So you should look at the tax you pay in the correct perspective. You should not say, oh, I paid 10,000 rupees tax, I paid 25,000 rupees tax. That's not the way to look at it. You should look at it with respect to your portfolio, with respect to the amount you are actually going to safeguard. And then if you look at it, it will look very, very small. And I keep saying this several times. Tax is the peanuts we toss to the government on our way to becoming multi-crorepathies. Unless we take this kind of attitude, we will always be worried about saving tax. Oh, tax is going. That kind of, I mean, the worst thing in personal finance is to worry about tax and to save tax. Most mistakes are based on this. And some people will argue the losses are notional, as if gains are not notional. If losses are notional, then gains are also notional. They will say losses are notional but taxes are real. That is nonsense, because the loss is not notional, because the time lost between October 2021 to July 2022 today, when I'm making this video, that time is lost forever. You're not going to get it again. So yes, the market will move up, but nobody knows when. But I have safeguarded my gains. I am able to sleep in peace during this time from October to June or July. I am able to sleep much better, because I know that for my goal, the target corpus is already available in fixed income. That is the price I'm paying, and I will happily pay that price. So nothing is notional. If you are saying losses are notional, then you must accept that gains are also notional. I would say nothing is notional in the stock market. Everything is real. So you should just have the right perspective and act as per your goals. Bye-bye.